Okay, so now I have to maintain this level of enthusiasm, which, if anybody knows me, is very hard from my face. Shall we get going straight away? So I think we've been hearing, and I've been covering crypto for a long time, that institutions are coming, they're here. Was 2024 the year that they actually arrived? This is for everyone.
Yeah, I'd say 2024 was a bit of a watershed moment, and the institutions arrived largely on the back of the ETF launches, spot ETF launches in the US on January the 11th. And you saw a whole new wave of investors entering the asset class, in large part because they had this vehicle in the form of a spot ETF that was very familiar with them, that they could utilize. But they weren't only just going long, right? So very well documented basis trades, carry trades from hedge funds, etc. So quite a diverse range of investors looking for a diverse range of outcomes. So the spot ETFs were one, but I would also say the US election itself was a big driver for interest in Bitcoin, because in that electioneering we heard, and you only tend to hear about it in election years outside of crypto circles, where everyday people not in the crypto market talk about things like deficits and how to finance a deficit, and there's this thing called Bitcoin, it never runs a deficit, it has a limited supply, etc., etc., etc. I think that was probably an underappreciated tailwind. I mean, Anthony probably knows better than I how political narratives shape the way that investors think. I'd be interested to hear what Anthony thinks on that.
And also, did the institutions actually arrive? You're from the traditional world, but you've always been early on crypto. Do you think we're there yet?
Why don't you answer the institutional question? Is that all right?
Sure.
I can get into the politics, but I just think Chris is better suited on the institutional side.
Sure, of course, yeah. So look, I think are the institutions coming? I mean, it's almost now a meme in crypto. Like every year it's how the institutions are here. The institutions are here. So look, did they arrive in 2024? I'd say yes and no. I would say that the activity at the end of the year was orders of magnitude higher than at the beginning. So I think that we can celebrate that. Do we have the kind of market penetration that you would expect in a $3 trillion asset? And I would say the answer is decidedly no. So is there more to do? Is there more to come? I would say absolutely. But yeah, look, I think that for the reasons that Sui outlined, I think the ETFs were a massive watershed moment. I think actually creating that bridge between the legacy traditional financial system and crypto, that was really the first instrument that bridged those those two. So now all of a sudden you can securitize Bitcoin, you can borrow against it, and all the rest of it. That's a very meaningful change. And absolutely, the election I think is going to have meaningful impact going forward.
So I would just add a couple of things. I don't think you're going to see full-throated institutional demand, at least in the United States, until you have full-on regulatory clarity, definition in the regs, specificity related to stablecoin legislation. And, I think one of the big court cases that was won last year was from Coinbase. Coinbase went to the judge and said that the regulators won't tell us what to do. And so we're shooting in the dark. They're regulating by enforcement, and there's no clear delineation of the rules. And the judge came back and said to Brian Armstrong and his team that they were right. So I'll just say three quick things. Number one, I predict that we get that by November, if latest March of 2026, but probably sometime late November before the holidays, you'll get that legislation. And why is that the Democrats are now scared out of their minds about the crypto political action committees and the assault on them from the crypto industry. And there was no reason for them to go so hard at this industry. It was really, and I think people will look back on this and they'll say that Gary Gensler and Elizabeth Warren not only lost the crypto vote, but they destroyed the franchise that the Democrats had in Silicon Valley. Because once they soured on all that innovation, lots of Silicon Valley players, including Elon Musk, went over to the Republicans. And then just the last point, which I think is is relevant for this conversation. With Donald Trump, unfortunately, you get everything. You can't, it's not an a la carte meal with Donald Trump. You don't go to the table and say, okay, I'll take the great crypto regulation, I'll take lower taxes. You get the grifting meme coin, and you get the insanity related to tariffs. So, just remember, you're getting the complete menu plus the wine list with Donald Trump.
So we're obviously going to get back to that, but just you mentioned sort of the tariffs and I want to bring it to the reaction today. So one of the things we wanted to discuss is how, much of the refrain was institutions are coming, it will mean crypto becomes less volatile, right? But potentially. Or at least I guess if it's more liquid, then a little bit less. But today, we had ETH go down 25%. So how has actually sort of crypto trading evolved now that perhaps are a little bit more, they're not all here clearly, but there's been more institutional flow into crypto. What have you noticed from your vantage point, Sui?
Yeah, as an index provider, we produce the BRR, the BRRNY. The majority of the world's ETF assets are benchmarked to the indices we provide. So myself and my team spend a lot of time staring at data. So we're staring at trade data, order data all day long, and I think that in this past year, in 2024, what you've seen is, if you look at the realized volatility of Bitcoin or Ether, or any of the majors, if you look at that hour by hour through the day, which is the type of stuff that you end up doing if you work at CF benchmarks, you will have seen that realized volatility really picks up at 1400 to 1500 UTC in that hour. Why is it that hour? Because that's when the Wall Street Open is. And that is a distinct change. That is historically, number one, realized volatility was much more evenly spread through the day. There were peaks, particularly coming to the London close, actually. Traditionally, that was where you saw the bulk of realized volatility because of the London close. It means Wall Street is also open. So you saw a lot, realized volatility was higher then, if you went back 4 or 5 years. But in 2024, there is no doubt the Wall Street Open, so that's the ETFs and the CME futures market, when they open to all their members, in that time, that's when the Bitcoin market moves now. And so that is a big structural change, and one that I'm sure has caught out the odd trading firm here and there, and it's very hard to see how that will change. Once the genie is out of the bottle, once the world's largest capital market is out of the bottle, you can't put it back.
Yeah, I mean, we see a lot of the ETF creates and redeems, and so we're getting spikes in volatility on exchange as and when those are coming through. What I would say is that, that will change as different products come and go. I traded oil for 17 years. For the first 5, because we were still open outcry markets, 2 minutes past 10 on the IPE, the International Petroleum Exchange, massive amounts of activity. Why it opened at 2 minutes past 10, I never really found out in 17 years. Bit bizarre. But so you'll see. So and then of course we go electronic, and then it just blends in through the day as European and London gets in. And the same was true at 7:30 in the evening. NYMEX closed, flurry of activity. That used to be 9:30, but then post 9/11, they kind of shortened the trading window. Options are still tiny in crypto. I think that they'll be a lot bigger as and when we start to get settlements around that. That's going to create, it's going to change the liquidity profile through the day. So I think this is just now, it is changing. It used to be a sort of blend 24/7. I think over time we'll start to see that. We'll start to see these spikes around derivative fixings.
So as sort of more institutions come, will they be content, you think, Anthony, with the market structure that crypto has now? Or do you see, the bigger players, the banks in their trading capacity, in the market, big market makers move and trade on Coinbase? Or will they form their own exchanges, their own we've seen big custodians make a move, but...
So, this is my 35th year on Wall Street, so I'm going to draw an analogy to the NASDAQ, which used to be called the over-the-counter market. And so in the over-the-counter market, when I joined Wall Street, the spreads were 50 cents. It could have been 75 cents. And then obviously Arthur Levitt came in the mid 90s and he created the decimalization of that market to try to tighten the spreads. I think that's sort of where we are in the crypto markets today. If you look at where things are trading and you look at the way they gap in the marketplace, it's not the stock exchange, it's not the New York Stock Exchange or even the NASDAQ in terms of where the market making is. And so if you're telling me that the United States, and I predict that they will allow the big banks into the space, will allow Goldman to make markets in cryptocurrencies or Bitcoin, Ethereum, et cetera, those markets will tighten. You'll see more demand in those markets. The prices will go up, just like what happened in the over-the-counter markets. And it'll take time, but it's going to happen. And so the question is, we're impatient in this industry. You know, I was laughing with some of my friends in New York. Donald Trump was sworn in on the 20th of January at 12 o'clock. At 12:01, everybody in the industry wanted a strategic Bitcoin reserve. And they got pissed off that it didn't happen. They started selling off Bitcoin by 12:07. And so the industry wants this stuff like immediately. It's like instant gratification. But if you just think about the progress that we've made over the last 5 years, it's been monumental. And I think you'll get exponentially more monumental progress over the next 5 years, particularly if these players are able to enter the market.
So do you think, not to get too high level, but do you think that crypto will be traded more like existing assets, or do you think some of the promise that the underlying technology and the, you know, because for a long time we kept blockchain and crypto separate, but, you know, potentially it could be the same topic, right? That actually, you know, it will be traded in a different way. Like, will it become like, you know, stocks are traded now or in the same way, or do you see, because institutions need the same structures and they have regulation, and so eventually you'll have the same?
So what you're asking is, are we going to see the tokenization of everything, pretty much? Yeah. Look, and I think in the fullness of time we will. But look, to be clear, right?
And which token, by the way, because that's the one I want to buy. So tell us.
Right, yeah. But to be clear, I think that, you know, there's still a lot of work to do in just market access to crypto itself. Like, that is still, you know, relatively painful. Yes, you can open a separate account on a crypto exchange or a crypto custodian, but you can't, you know, there's no U.S. bank that's offering, you know, access through a traditional prime brokerage. And, you know, that's what, you know, the banks are really the gatekeepers to the massive pools of capital out there. And those gates are closed right now. So I think that, you know, yes, in the fullness of time, we'll see tokenization and everything. We'll see, you know, Apple stock traded on blockchain and so on and so forth. But I think there's a ton of work still to do in creating the mechanisms by which people can access this marketplace.
Yeah. So the mechanisms are likely to be the existing ones. It's
Yeah,
not
look,
reinventing the mechanisms, basically.
And yeah, look, I mean, you know, with SAB 121 in the US and Basel III capital requirements in Europe, it's prohibitively expensive for banks to do anything. And look, that's been a very deliberate stance of regulators to keep these systems and these worlds apart. And, you know, that's slowly starting to be pulled down. We saw the repeal of SAB 121 almost as soon as Gary Gensler left office. And so, you know, what happens in Europe, I don't know. Like, but we're starting to see progress in that direction. And I think that's the next big evolution here. It's, you know, to a certain extent, you know, people are lazy. You know, if you can do something easily, I mean, look at the ETFs, look at the success and the amount of money that brought into to Bitcoin and Ethereum and the ecosystem more broadly. Now, you know, and you speak to Fidelity and you speak to BlackRock, they'll tell you that the vast majorities of the holders of those ETFs are still retail. So they could have all gone and opened an account on exchange, but they didn't. You know, they just wanted to be able to access it through their existing brokerage account that they hold wherever they hold it. And as soon as that was available, then we see this wave of money come in. And I think, you know, with institutions, it's more difficult further still because you've got to, you know, there needs to be, you know, assessments of vendors and so on and so forth, whereas you don't need to do that with your existing prime. So I think, like, opening up those channels is going to have a really dramatic effect. And just given the changes we've seen in the US, SAB 121, repeal, et cetera, you know, that's starting to happen.
I guess I have a question for you guys, if you don't mind. I guess curious about this. The regulators are still looking at these banks through the prism of 2008. And if you look at the constraints and the Basel III balance sheet stuff, isn't that going to impair the ability to get crypto up and running?
Yeah, I think that's a great point you make, Anthony. Is that it's very easy to the narrative around banks and their lack of participation has been very centered around like bogeymen like Gary Gensler and Jamie Dimon and their own reluctance to engage. The reality is particularly banks, US regulated banks, the bank holding companies technically, so your Goldman Sachs, your JP Morgans, etc. There's an absolute alphabet soup of three-letter agencies that have various, so the OCC, the FDIC, the Fed. It's a whole mesh of regulators that are responsible for specific outcomes, like deposit insurance with the FDIC, and they impose specific regulations on the banks. So it isn't a case of Gensler leaves office and that's it, it's over, because you've got a number of regulators and then a number of multilateral international regulatory advisory like Basel III that is also in the mix as well. The interesting thing about say Basel III is this change of administration. Crypto or no crypto, Donald Trump was going to bin Basel III for American banks regardless, right? That's just not happening as far as Donald Trump is concerned. And so the change in administration, it's a very profound change on the banks in general, regardless of whether you talk about crypto. Once you add crypto into the mix, then you see that the possibilities are certainly there. They're certainly greater. But just on the point of TradFi meets crypto, obviously there's a lot of focus around tokenization for obvious reasons, but there's also, it sometimes gets lost that a lot of what the TradFi world is interested about crypto is yes, the assets, yes, blockchain, but also the paradigm in which it operates, right? So 24/7. 24/7, about 10 years ago, people started making noises about it, and then it quickly disappeared. It's now very much back on the agenda for Wall Street. It's like, it is possible, because there's these guys who are all on AWS and move tokens around. They operate 24/7. Why can't we, right? So 24/7, instant settlement. All of these things that we take for granted in the crypto world, the TradFi ecosystem is as interested in that and how to co-opt that as it is in potentially trading Bitcoin and tokenizing things, right? And I think that sometimes gets lost, that some of the innovations of the crypto ecosystem are just as interesting to Wall Street as the assets and the technology.
So speaking, I guess, of capital requirements in 2008, part of that was because there was a big crash, right? So do you think crypto has developed, because crypto tends to have very short-term memory, goes from peaks to crashes, and everybody's, yay, we're in top, and then I've been around from the beginning. So do you think the structures have been put in place to safeguard investors? And not just, I'm not talking the man on the street, I'm talking, SkyBridge, like all the hedge funds that, went, not that many, but a lot of them were freaking out when FTX collapsed, right? So if you bring in the banks then, and you bring, do we have the safeguards and the regulation in place so that the banks can enter it safely? And so if there's another crash, it's not constricted to the crypto world, because that wouldn't not only be good for investors, but also for the sector's reputation and be back, How do you feel about that?
So I think, if you look at what's happened in the past, it's really like a failure. It's less a failure of technology, it's a failure of people. And so, look, when was the last time we had, a major crypto hack of, when you look into the details of what went wrong and all these things, it's shocking how horrible the security measures that were in place were. And, you look at FTX.
But for example, there were no audited firms. There were firms that didn't have boards. How many of the funds that, Anthony, you invest in now have boards that are clear, that you know who the board is? Like, there's some structures that are there to protect everyone, not just,
So, I mean, the big, when you really analyze the FTX situation, to commit a financial crime of that magnitude, you have to have a very close circuit of people. And so firms like ours, we have 50 people checking money. It's not just the people inside the firm, it's outside accountants, outside law firms, outside administrators. And what Sam did is he closed the loop inside of 3 or 4 people. And by the way, that's what Bernie Madoff did. If you look back into 2008, he had 3 or 4 people, and the crimes get perpetrated that way. I think so from a due diligence perspective, the 25 venture capitalists, SkyBridge, all of us who made a mistake with Sam, we didn't really understand where the nerve center was. And he did a very good job of manufacturing a data center that looked great to all of us that was a fraudulent data center. And so, I mean, there's lessons there. But I think the big issue is going to be how much capital can a major bank put into Bitcoin or other cryptocurrencies? And then what would the charge be on that capital? So as an example, if you have $1 in the bank, they don't get charged on that. That's part of their equity. That's part of their assets. But with Bitcoin having a 50 vol, an 80 vol, I don't know what the vol will be when it gets to the point where they allow it, what will the capital charge be? And what will the magnitude of that capital charge be? And I think it's going to be very high, and a result of which is going to be hard to get those banks to make principal bets like they do in the stock and bond market, at least until they get a better handle on the volatility.
So what are some of the other instruments that might arise that allow them to sort of participate, but not, with those capital charges on balance sheet?
If I could just add to that really quick. I mean, I agree with you. And if you look at sort of equity vol, you look at bond vol, much lower. Banks trade physical power. And the physical power is like, you think crypto's scary in terms of volatility? Physical power is on another level. So I think that, there are mechanisms by which you can get comfortable with the market volatility.
See, I'm less worried about the bank and more worried about the regulator, because I think the regulator is scared out of their minds. And when people like Jamie Dimon say that it's a decentralized pet rock or it's a decentralized Ponzi scheme, and these regulators have been burnt before, I'm sure you could go before a group of regulators and make the case that this is like power, and this is what we do in the power markets. But for some reason, power is more tangible to a regulator than this, in my opinion.
No, I think that's a great point in that, you raised, Chris, there are other markets, particularly markets that have that are terminal, right? That's the thing with power, right? It's this half hour, and then so as you get to the end of the half hour, my word, it just goes all over the place. But that is so that people can boil kettles. Right, so yes, if you're a regulator, you go, oh, I don't really want to deal with this, but I can't stop people from boiling kettles. That would be great. I have to deal with it. So Anthony, your point is well, it's a pet rock, right? So I don't have to deal with it. I could just say no, and I think that is still a risk. That's definitely still a risk. That because of that seeming lack of utility, right? That fundamentally no one is buying Bitcoin to be able to fulfill a real-world physical delivery of something tangible. The interesting bit there, that's true of Bitcoin, but to a degree it's only in a very small sense today. It's not true of Ether. There are industrial companies who hold Ether on balance sheet to be able to pay bills, to be able to make things happen on the Ethereum blockchain. And those companies now include BlackRock, right? Forget the ETF, they have the Buddle fund. So to make sure that thing moves around and on the Ethereum blockchain, to make sure it operates smoothly, BlackRock has Ether on its corporate balance sheet to pay those bills, right? To make that happen. So I think that as that utility piece grows, so that regulatory conversation moves to a different place. It's like, no, well, this isn't just speculation. There are people who need to hold this stuff to be able to effectuate industrial, industrial activity on chain.
And look, you have, to augment that, you have, a company like Nike that has sold several $100 million worth of digital collectibles. They're selling those for ETH, and they need to corporate risk manage that. So, there's definitely, where do they do all the rest of their corporate risk management? Trading desks at banks.
So we don't have a lot of time. So I do want to get some regulation, Trump, U.S. questions, because the industry, as Anthony was saying, was like euphoric. That Trump got elected, it got a dominant, central point of conversation for for a presidential election. Do you think by the first, I know it's the beginning, but do you think the industry will end up getting sort of regulations that reflect everybody, actually the industry's needs, or we'll get, as you're saying, a mixed bag of meme coins? Like, what's happened so far? What does it signal to you in terms of what might happen?
So I'm, again, all the vagaries of Donald Trump aside, I'm optimistic for 3 reasons. Number one, Besant, Atkins, Lutnick, all these guys are pro-Bitcoiners. Number 2, the Democrats have had the daylight scared out of them, particularly the Sherrod Brown case, where $40 million went in from political action committees associated with the blockchain and crypto and knocked him out of that seat. And so, guys, these senators have a 95% incumbency success rate. So you just have to think of the magnitude of an 18-year veteran who was the head of the Senate Banking Committee getting knocked out of the game. And so that's got them scared. And then the third thing is there's great momentum now in the industry. There are guys like Brian Armstrong or others that are not going to let up now in terms of where they think the regulation needs to go. And I think the combination of those things are very good for the industry, even if you come up with a Barron coin or an Eric coin, or you pick the number of coins that the Trump family is going to put on chain. It's not going to disrupt, I think, that momentum from a regulation perspective.
And what do these things sort of do to the industry in terms of trying to legitimize itself as not a pet rock? Like, what do you think the sort of institutional investors, allocators, they understand that there's, the more serious assets and then there's the meme coins, or is it all lumped together? Like, reputationally, do you think?
I think that's incumbent upon us or everyone in this room to change that narrative, right? And to do the homework, to do those hard yards, and convince people with cogent empirical analysis that evidences that is not true. So, one of the things that CF Benchmarks has done recently, we recently published a paper on risk premia, return factors in crypto markets. So we took the top 60 cryptos by market cap, we regressed their returns, and we believe we have evidence that risk premia are at play in crypto markets, i.e. crypto markets are not a random walk. Because as one of the there are swathes of investors out there who believe that, because it's just a pet rock, blah blah blah, it's a random walk, so it's not an investable asset class. Well, we believe we have empirically proven that is not true. That return factors, return drivers that you see in crypto markets are actually not very different to the ones you see in equity markets. It is not a random walk, and I think that to convince the next swathe of institutions, next swathe of investors, it's this. You've got to sort of meet them on their ground. You've got to talk about an asset class in the way that they understand an asset class, to evidence that it is an asset class and it is not a pet rock, etc. And I believe that with the momentum that Anthony mentioned, investors are more open to listening to that now than they ever have been.
Can I just say that I think it's absolutely wild that we have a $3 trillion asset class and people are still questioning whether it has utility. I just find I personally...
Maybe it's because there was a bit of confusion in utility for investing versus utility use. Well, I remember people were raising ICOs saying my token will be used to store files on the internet, right? So there's a dichotomy there, perhaps, right? That might lead to... we're going to be used for payments, and that's still not happening at scale, perhaps.
Well, look, we have $200 billion of stable coins. I don't know. I just look everywhere and see activity. I just find it's whether it's in digital collectibles, whether it's in stable coins, whether it's Bitcoin as a digital monetary commodity and a savings technology. I just find it. We have these conferences and people are still talking about utility. It seems wild to me. Anyway.
Well, I know we're in overtime, but I'll just say this: if you can get a hold of the BlackRock PowerPoint presentation related to Bitcoin and the job that they're doing, they've got legions of consultants, legions of salespeople out explaining to institutional investors, endowments, unions all over the world the promise of Bitcoin and why Bitcoin is a great diversifier into somebody's overall asset allocation portfolio. And if you read that and you take a deep breath and say, okay, where are we going to be in 3 years? I think the answer is higher.
All right. Thank you so much.
Thank you, guys.
Thank you.
My dear friends, give it up for Anna, Sui, Chris.